With our guest today, Mr. Sharma, Head of Private Client Group and Capital Market Strategy at HDFC Securities. Mr. Sharma, as always, welcome to the show.
Good morning.
Now, let's start with the oil prices, something again which we have been talking about for some time, important for the bond market, sometime again important again for our economy, fiscal situation, sometimes again market draws again some conclusions from that. Of late last 3-4 months, largely neutral as a development for the markets. We have seen oil prices again now in the last 2 months not been able to cross $70 in terms of Brent.
Yes.
And from all the developments, all the sort of news flow from Middle East, President Trump. But now, how do you see the recent correction in oil prices and the recent sort of news flow around the OPEC extending their own agreement between the OPEC and non-OPEC members?
Yes.
What's the conclusion you're drawing from that?
Okay. Let's look at, step back and take a larger picture. First and foremost, in 2014, Saudi Arabia, OPEC decided to teach US shale gas operators a lesson, and they wanted to shut down. And in a way, because they were funded by the banks, also ensure some trouble for the banks and therefore to the US economy. Ultimately, in that one-upmanship, Saudi Arabia blinked, and they had to then resort to the current trend of cutting down production. So first they cut 1.8 million barrels of production. That didn't help. Then they went on to include Russia and had 1.2 million barrels cut. That also didn't happen, and now they have decided to extend it to 2020, March 2020.
And this was added with the Venezuela and Libya drop in production also.
Yeah, add to that the 1 million barrels of Iran which is not there, 0.6 million barrels a day fall in Venezuelan production. All put together, and despite this, we have these kind of prices. Usually, after such kind of an act, the prices should have gone up. They have tanked. The chief reason, what I feel, is that till now, the production cut theory has happened, and as a result, the participants have got a good price. Now, despite these cuts, if the price tumbles, let's say, I'm talking about the WTI, below $50 a barrel, then perhaps a new question will arise, how much of, let's say, adherence to the rules we will see. Because OPEC has been very, let's say, the earlier players have not at all participated in the production cuts, but for this time. So now that old behavior may come back.
Especially when they're seeing that the US is continuously gaining market share. They've added 2 million barrels in the same time period.
Yes.
Which implies even they're cutting, it's not serving their purpose.
Yeah.
You are just taking their market share.
Yeah. So therefore, the other players will start producing more, and the day that we see, that will be the time to short crude. At that point of time, we are only saying it's good for India, but if somebody wants to take a positional trade on that, that should be the time. Look for those kind of signals when OPEC, all the producers are, barring Saudi Arabia, are producing more. That is the time we need to look at.
So indirectly, it also implies that for us, crude is really not a concern in FY20, because these developments are ensuring that crude is not on a runaway rally, unless an exception, some war breaks out in Middle East. But in that outlier scenario, it implies that it is not that sort of concern like we used to talk 2-3 years back.
It is not a concern at all. Mind you, OPEC can only address one thing, and that is OPEC can only address production part, that is the supply, and that too only partially. Increasingly, US now is the largest producer. More importantly, it cannot address the demand. The fact that the world has been slowing down because of the trade wars happening, the general demand is not rising at that extent which can then take the price. To that extent, the demand will further start decreasing from 2024 when exactly the electronic cars take over. So till that point of time, I don't think it will be an issue. So I am all gung-ho on India, and therefore I'm not looking at oil assets at all.
Right. So one conclusion perhaps could be that if you are looking at oil price as a concern, whether you are a bond market trader, investor into securities, crude is definitely not a concern from FY20. But there are some themes which are related to crude. So let's have a slight mild discussion on that here. ONGC as a producer, if crude is not gung-ho, then is ONGC again not really worth investing? What should be the word there? And along with that, let me add another part here. Whether we talk about the proxy, whether it's aviation, OMC or paint, any word, anything which you think perhaps fits the bill.
Okay, let's look at the upstream oil producers like, for instance, our own ONGC and All India. See, to be fair, our institution may have, but for retail investors, we have been advising investors to stay away. Essentially because ONGC has not added a single barrel of oil on its own. Whatever it has added is on theory, from the point of view of that its subsidiary, whatever they have got over in those policies, in those places where it is very difficult to produce.
And they've been just investing, so free cash flow generation is also not
so therefore, it is not such a great story. But all marketing companies, essentially, I think, have a larger room to play to go up further, because there is no need at this point of time to subsidize diesel and the petrol what you sell. More importantly, they can also use their land what they have for other purposes. If tomorrow they want to go for setting up some kind of, let's say, shops and other kind of things at their petrol pumps, it augurs well for them also. So all marketing companies are relatively better placed, and paints and other companies will definitely like this new weather, new climate, where they are not going to see increased prices.
So from the sort of both perspective, might be slightly tricky, but again for the investors, if we can simplify it, if you want to go into OMCs, then again you worry about two aspects: marketing margins and your refining margins. Marketing margins, no major election calendar, so again you can have some confidence there. Refining margins, it's not looking good again so far again for FY20 perspective, and then you start comparing it with private refiners. So OMCs, is it providing you a better opportunity, or paint companies which are largely private, few in nature, and also again great return on equity, between these two things where your confidence will be higher?
I think the safety is much in the paint companies like Asian Paints, where you have had a good, let's say, capability to transfer the prices in case they increase to the customer. And when you own the customer, when you understand his requirement, you are also continuously changing your products. I think that is well placed. They also have the wherewithal to absorb some of the losses in case they have to, in terms of not passing on, they have an option. So they are much better placed as compared to the all marketing companies.
Okay, so given the choice again, if you wanted to play on the crude as a proxy, as Mr. Sharma is saying again, paint perhaps is providing a better sector opportunity. Stocks are subject to analysis on the stock, but Mr. Sharma wants to add something.
Another sector that I'll not be able to name the stocks is aviation,
right,
which directly benefits out of the lower air turbine fuels, because it goes on to ATF makes around 37% of their operational cost. So any dollar decrease, if it happens, eventually.
And consolidation also, so more market share?
Yes, the sector is going through consolidation, and these are opportunities. To what extent these companies who are there now presently operational?
I'm not asking the stock, but is it a better idea to play on the sector leader or play on the sort of smaller players?
No, it's better to play on the leader rather than something else. Obviously, I'm not naming the stock.
Absolutely. So while the analysis again is a matter of choice for our viewers, but aviation is something which Mr. Sharma is saying again you can take a look with interest, and also results are going to give you some more clarity there. But a sector which is facing consolidation for sure over the last couple of months here. Now that's crude sentiments. Now budget is something which a theme is right now. A lot of expectations from budget. We always say again over the last few years budget has become more of a non-event, primarily because the taxes most have gone into GST.
Yes.
Then again we have most of our sort of developments now happening outside of budget.
You are absolutely
now,
right.
The question is, what do you really expect from the finance minister? First budget of the second term, perhaps no major political compulsion. So this has to be something of a landmark budget. The market really has to be happy. So what do you expect from it?
Okay. Let me tell you that while I think of what the finance minister should do, may or may not do, because looking at the kind of money that the Reserve Bank of India will ultimately transfer, but our own sense is that this version 2 of the Modi government, the government should pick up a page from Mr. Atal Bihari Vajpayee's NDA term 1, in which they strategically disinvested the public sector units. It was of a sentiment which is good for the sentiment, and also brings in the mullah for the government without taxing the public as such, because the government has no business to be in many of these businesses. Now let me tell you why it needs to be done. It also needs to be done because much of the ills of that economy, of those decisions which Mr. Nehru took in 1956-57 when he privatized the company which is now known as LIC. Then Mrs. Indira Gandhi, privatization, public sector, let's say nationalization of those banks, all 19 banks, 1969, and also in 1975-76, when because of the Charles Nala unit, that event, the government decided that the private sector was not paying adequate attention to coal mining, safety of coal miners, so therefore they nationalized and made it a Coal India. It's time to relook at all those things, because these are events. If the 1969 privatization had not happened, there was no need, and we would not have these currently ills of looking at so many NPAs, because this wouldn't have happened in a private sector.
And a continuous allocation of money going into banks instead of infrastructure.
Yes. And look at the way in which, because the unions, because with the nationalization came the unions, and whether it is LIC or whether it was the PS public sector banks, they stopped they delayed the ultimate process. For instance, while Mr. Manmohan Singh of 1991-96 did so many of reforms, 1995, but he couldn't touch insurance, which only the NDA did in 99. So therefore, some of it has been done away with, and so look at these insurance companies which are prospering now, doing much better, and better services for the consumers. So similar thing can happen in all of these units, many units, and Coal India to begin with can be broken into subsidiaries. You can break these companies and privatize these, give these to the coal miners, the power units which need power, give them coal connectivity, give them the mines. You will have better.
I have a question there.
Yeah.
And the question is, suppose you are saying let's privatize the Coal India. Let's break it because Coal India is too large again for somebody to really buy. So again, break it, sell it into pieces. The question here is, how do you address this? On one side, you're going to make it private, which is the supply, the feedstock of power companies. And then you have discoms, which are nowhere in terms of strong balance sheet or financial balance sheet here. It is still again some time away. Because you are pushing NTPC Power Grid joint venture, you are pushing private distribution companies. But the reality of the matter is, we have state distribution companies which still have their own sort of political discourse here. So how do you then correct this mismatch? Because you're supplying coal at a much lower profit margin.
You have today a government which is in absolute power at the center, and the present dispensation is also in many of the states. My own sense is this is the time to bite the bullet. This is the time to let the consumer pay. This is also the time to let these power companies give them the coal. They will be responsible for their own productivity of coal mines, and they will be responsible for their own cost of power. So raw materials. To that extent, I think the connected to this is also the fact that the government today, many states, doesn't have the power, or let's say the bravery or the guts, to go into certain sections of a city where a particular community stays and they don't pay bills. It's time to change all that. It's time to take those hard decisions and do it right now. Because ultimately, if you have to take all the proper people, all the poor people with you, then the money has to be recovered from whatever caste or creed or religion that person may be. The money has to be recouped, and therefore the consumer has to pay, and therefore these companies will be able to deliver power at the right rate if they have the coal mines with them.
So basically we actually need to address two issues.
Yes.
Number one, again, you need to address the privatization of coal, because that will increase the production productivity much faster.
Yes.
Because Coal India has not been able to deliver over the last couple of years. And second is, you need to basically accelerate the privatization of distribution arms, so that again then you can actually address the transmission losses, you can address the recovery factor, you can again then basically control the power cost again without actually escalating the power cost if you privatize the coal. So government really needs to do something on privatization in the power sector. That's one aspect. Second aspect, what do you think again, PSU banks you talked about, is this something where the smaller, weaker PSU banks, government can start again and just divest and generate resources? Is that something you think is practical, or is only going to be in the wish list?
Okay, I'll come to that, but let me give some credit to Coal India. Under the present dispensation of the last government, the productivity has increased, but unions still call the shots. It's time to now break up into subsidiaries and try and experiment at least one of the subsidiaries. Now coming to banks, I think it is important for the requirement of the nation is that the credit wheel should start flowing all over again. So therefore, you have to capitalize these public sector banks which were not lending. Once they start lending, the credit cycle will start all over again, and the crunch which the public is facing will be mitigated to a great extent.
But how can they start lending? Should government infuse more money, or should government
capitalize the money?
Which means more money should be now.
The money that comes from Reserve Bank excess capital should be used for capitalization of these banks, which in turn will move into the economy per se. More importantly, before the government writes that check for that raising of capital, it is important to put all those processes in place. Maybe the government is already working on that if you are not changing the basic structure of those banks, then lending money, allowing them to lend money, well, again you will have NPAs after some time.
But then, as you're just advocating disinvestment, is that something which you think should not be done then?
Disinvestment should be done, but not of the public sector banks at this price. Consolidate them, and thereafter you can do it.
Get a much better price.
Yeah, disinvestment lies in some other places. For instance, Coal India, subsidiaries, and many other units like BAML was one unit which was picked out by the last government for strategic disinvestment, wasn't done. It's time
because
to
they were only talking about 26%, and who wants again than that?
The moment you give 26% to somebody, and also, see, in order to ensure that this time there is a real, let's say, demand for such, and people take it on face value, is fulfill all the promises that NDA had given. Government today has 29% plus something in Hindustan Zinc, 26% in Balco, and 26% in Tata Communications.
So you want to get government should sell all of that?
Sell these units in a very transparent manner, sell the stake, and look how these companies will do well. The moment you do this, then the moment you strategically privatize one company, all the PSUs will then rise, and you will have a sentiment which is very different. Today, if you announce a follow-up offer in Coal India, or for that matter Power Grid,
you will draw confidence because absolutely you will draw confidence because that will get completed.
Yeah.
So one question before I go across to some investment themes also, is that we talked about coal, we talked about the existing sort of minority stakes government has in a couple of mining companies. Whether it's example is steel, or whether like SAIL, or whether it's example of more mining companies, or even if you talk about HAL or other companies, are these businesses something which you think government should be really be into? Can government really monetize the money and then again focus on building more capital assets?
Obviously, the government has no business to be in such businesses. First and foremost, privatization increases the productivity, which we have seen in Tata Communications. Erstwhile Videsh Sanchar Nigam, it's a company that pays more than 20 rupees in terms of interest per share. So, all because the government has not been able to, government does not have the money to put in the rights issue and doesn't want to dilute its 26% stake. But the Tata has bought over that asset, underlying sea cables, when they got hold of that, and which is now allowing the company to stay and being relevant in the telecom space even today.
Right.
So the moment you privatize, things will happen in a much better manner.
So there are ample of choices. It actually boils down to what government actually really wants to do, and whether the government actually wants to grow a business in a particular sector, or it actually wants to get out. A tough choice, is the government really 10 years of future in the mind here. But that's about a lot of discussion around the budget. But whenever you are there in the show, we always ask you some investment themes from portfolio building perspective or budget perspective. What do you think at present, what are those relevant themes right now?
I think what is important is we can only propose, and God and Goddess Lakshmi will definitely do what they'll dispose. We can only propose. But the fact is, even if the budget will let it be a good budget, let it be a bad budget, but the fact that you will be able to make some money in the process, irrespective of what the budget is, then there is visibility only in the banking space.
Okay.
There are some good retail banks which have industry exposure, money will come back from those people on those assets which have been written off. There will be one-time gains, and also these banks have set their house in order and have brought down their costs and NPs also, and are available despite the increase in last 8 months or so. There's still some room to go. They are available at much cheaper rates than
all bets on private banks.
Yeah, private banks.
And when you say private banks, betting on the largest, or you're saying either mid-tier or large tier, like how should investors really drill down into some metrics or some sort of computer sectors?
Here I can name them. You can have ICICI Bank, that is among the cheapest available. If you look at FY21 price to book value,
around 3 times.
No, it's around at maybe something. If you look at 21, it's 1.4 or 1.5.
That's indeed inexpensive.
Yes, and Axis Bank is another which is available maybe around 2. So these are the 2 banks where we see the profits increasing. Obviously there will be a good one-time measure, but the fact is these companies have set now processes which will mean that there will be no more further going, there will be no more NPAs of similar kind, and whatever we are going to see has already been discounted. So there will be a write backs. So one-time profit. Axis Bank, maybe the profits can rise maybe around at a rate of 65% CAGR for the next 2 years from last year. ICICI Bank, the ratio is even better, 115.
I'm tempted to ask you, does it also imply a similar CAGR increase in stock price over 2 years?
No, obviously similar you can expect, maybe more than that, but
because of
part of it,
the valuation re-rating and the earnings growth.
Yeah, part of it has been discounted, but still, if you were to buy these stocks from here, currently look at, I think a 50% CAGR from these rates is definitely a possibility. So anybody looking at safety, I think these are the banks which can lend.
Right.
Obviously, there are other large banks where our parent has the holdings, so we can't talk about them.
Absolutely. Again, I can definitely say to our viewers, again, HDFC Bank, perhaps another one again, which has been producing some good results. So, a couple of large cap choices. Mr. Sharma is at present talking about ICICI Bank and Axis Bank. Again, those are looking as good recovery choices for the next 2 years. Want to ask you one again, same in the financial space here. Now, whether it's gold financing, which again has been delivering strong growth over the last couple of quarters, despite all the upheavals which we saw in the last 2 quarters. And second, I want to ask you in terms of recovery play, whether it's RBL Bank or Bandhan Bank or some more in the private space, maybe Federal Bank. Because sometimes investors they really, or some more in the private space, maybe Federal Bank. Because sometimes investors they really think again these mid-tier were not able to perform and everything is going to rebound, they might actually do much better. So what's the real explanation at present on the mid-tier private banks versus the large-tier private banks?
I think the returns could still be higher in the publics, in the larger banks, in case the economy goes through the economic growth is not that fast, but the smaller banks will do much better in case it is faster. Right. So one can definitely look at the likes of RBL and all. Okay.
So that's one area, one sector, private banking space again, which investors again could keep on looking for this year. And before we wrap, Mr. Sharma wants to add another point.
Yeah, I can let you know 1 or 2 sectors.
Okay.
Will not name stocks here, where the per se the ratio of life insurance is one sector where our penetration is 1.7%.
Absolutely.
There it has to rise, and
also going to rise on a strong banking channel.
Yeah. Also look at the fact that in the banking space, like so 1970, 1994 when the private sector banks were given licenses, the 6% ratio was of the foreign banks, the rest was of the public sector banks. Today the foreign banks still have the same 6%, but 25% of the shareholding of public sector bank market share has gone to the private sector banks.
And still growing.
And still growing. Now these banks will obviously grow, but the fact is similar thing is there in the insurance business.
Sector, right.
You have an LIC which is going to where these private sector players will be able to gain market share from there, and also the industry per se, whatever it grows will also be a part of it. So penetration is very low. At the same time, you also have
Point taken. So
Yeah.
you're saying life insurance something which
Yes.
investors should really look from a good long-term perspective. 20 years, I think, which Mr. Sharma cited, in fact 25 years again if I take from 1994. So what Mr. Sharma is also indicating to you, life insurance at least for the next decade is perhaps could be the next sort of sunrise sector. So investors should keep on looking towards the large cap insurance, life insurance, not the general insurance we're talking about. We're talking about a life insurance company. So private banks, life insurance, two areas which Mr. Sharma is really optimistic about. And budget, perhaps the question now for the finance minister is the finance minister really going to bite the bullet on disinvestments? And with that thought, Mr. Sharma, thanks a lot for coming to the show. And it's a wrap on this edition of Market Guru. Thank you so much for watching us. Hope you enjoyed it. We'll take a short break, and after the break, lots more lined up on the other side.